Welcome to the deep dive. We've got the Loop Market Discussion, September 2025 financial overview in front of us. This is proprietary analysis from Devin McClarty, owned by D Investment Enterprise LLC, covering market action for, let's see, September 15th to the 19th, 2025. Our job here is simple. Cut through the complexity and give you the core strategic insights. We want you to understand how the market moved and maybe more importantly, why.
Absolutely. And if there's one single takeaway from this report, it really hammered home the theme of divergence and rotation. This wasn't, an all boats rise kind of week, not at all. It was a really sharp directional rotation. It basically created this huge gap between a handful of winners and, well, the rest dragging things down. Getting that is key.
Okay, let's unpack this then. Because, if you just glanced at the major indices, maybe you wouldn't see it so clearly. The NASDAQ, the S&P 500, they both finished the week green. Even the Dow Jones squeaked out a small gain. So on the surface, that sounds, well, pretty positive, doesn't it?
It does on the surface.
Yeah.
But the source material is very clear on this. Those gains were narrow, really narrow, not broad-based at all. It's that classic tail two tapes scenario. The indices were basically pulled up by some very concentrated strength, technology and consumer discretionary. Those two sectors did all the heavy lifting.
Right. And the contrast, that's what makes this kind of market tricky, maybe even dangerous. So where was the weakness concentrated?
Heavily in sectors sensitive to those bigger macro pressures, Energy and real estate were specifically called out as lagging badly. The report points directly to interest rates and commodity prices hitting them. But the drag didn't stop there. It really hit some areas you might think were safer. Financials and defensives were also definite, persistent laggards.
Okay, hold on a sec. I want to push back on that financials piece just for a moment. Usually we hear that higher interest rates can actually help banks, right? Boost their lending margins. So if rates were a headwind for some, why were financials lagging so badly here?
Yeah, that's a really sharp question, and the report does kind of touch on that nuance. So while yes, theoretically, higher rates can help net interest margins for traditional lending, the analysis suggests other pressures were just overwhelming that. Things like continued weakness in capital markets activity, fewer IPOs, less M&A, that hits investment banking hard. And crucially, the sources mention growing unease about loan exposure, particularly commercial real estate. That uncertainty seems to be outweighing any small benefit from slightly better lending margins right now.
Ah, okay. That makes more sense. It's not just one factor.
Exactly. And what's fascinating here is it sort of confirms this wasn't just a simple sector rotation. It feels more like deep investor conviction moving very aggressively into specific growth stories and just fleeing uncertainty wherever they saw it, even if it was in places like financials or defensives that are sometimes seen as safer bets.
Which makes that rotation feel, well, more significant, more serious.
Oh, well.
Okay, so let's pivot then. Who was doing the heavy lifting? You mentioned tech and discretionary.
Yeah, they were singled out as carrying the momentum.
And the report gives a specific example, right, for breakout strength in tech.
It does. HPE, Hewlett-Packard Enterprise. The analysis highlighted HPE as the #1 EV percent driver for the whole week.
Okay, EV percent driver. We need to translate that. That's their proprietary language. What does that mean for you, the listener?
Right. So when the report says EV percent driver, think equity velocity percentage. That's the core idea. It's their own metric for measuring how much a single stock contributed to the total positive momentum for the whole market or maybe just its sector, depending on context.
Got it. So HPE wasn't just up. It was actively propelling the market higher, a major source of the upside.
Precisely. It shows real, measurable conviction from buyers. It wasn't just drifting up.
And beyond that big tech push, was there any stability noted elsewhere?
Yes. Healthcare was mentioned as providing steady support, and they flagged USPH, U.S. physical therapy specifically. It was noted as being deep in a momentum zone. That implies, sustained strength over multiple days, not just a quick pop.
Okay, steady support there. And there was one other, RCI, Rogers Communications.
Yeah, RCI, Rogers Communications, Inc. The report described that one as quiet but powerful. Apparently, it maintained an impressive 7-day beat streak. Another one of their specific terms we should probably clarify.
Definitely. Beat streak. What's that telling us?
So in their system, a beat is basically a signal that a stock is consistently performing better than its recent short-term trend or baseline expectation. A 7-day beat streak means RCI triggered that positive signal for 7 straight trading sessions. It points to sustained underlying strength. Maybe not flashy, but reliable accumulation. And that's valuable when other things are shaky.
It really is. So, okay, if we stick with that marathon analogy, we've got HPE sprinting ahead, RCI running a steady race. But this discussion confirms, like, half the runners are falling way behind or even dropping out. Which brings us neatly to those anchors, the laggards.
Yep. And the analysis really drills down on the financial sector's continued underperformance.
And the specific stock they used to confirm that lag was Western Union, WU, right?
That's the one. WU was cited as the tangible evidence.
And here's where that system language gets, well, maybe a bit counterintuitive if you're not used to it. WU was the weakest performer, and the analysis said it was entrenched in profit zone.
Right. And your first thought is profit zone. That sounds good, but not here. In this specific context, the source material uses profit zone to mean the price level where bearish strategies like short selling are working really well. It means the downtrend is strong, it's sustained, the sellers are in control, and making profits on the way down. So WU being entrenched there confirms that capital is aggressively leaving financials. It's a measurable drag.
That's a critical distinction.
Ow.
Okay, so profit for the bears equals deep weakness for the stock and sector.
Got it. But it wasn't just financials dragging things down. You mentioned defensives earlier. Yeah, even traditional safe areas like consumer staples showed real weakness. They lost momentum. And the concrete example provided was the Hershey Company, HSY. HSY clocked a 3-day lag streak, similar to the beat streak, but obviously negative. It means it underperformed its baseline for 3 days running.
Okay, so weakness even in chocolate.
Uh-huh. And if you connect that to the bigger picture, when investors start shedding traditionally safe defensive names like Hershey, it suggests something maybe deeper than just reacting to interest rates. It looks like they're actively pulling money out of safety to chase growth more aggressively in places like tech and discretionary. That tells you something about the market's risk appetite right now. It's willing to embrace risk, which is important intel.
That definitely deepens the strategic implications. Okay, let's try and synthesize this. What are the main takeaways for you, the listener?
Well, the analysis really boils down to 2 core actionable themes from this rotation.
Yeah.
Theme 1 is just narrow leadership. The market strength is very, very concentrated, just a few sectors doing the work.
And while narrow leadership can keep the index numbers looking okay, it comes with real risks, doesn't it? Does the report give any clues on how to track when that narrow base might start to crumble?
It does, implicitly. The risk is exactly that. Over-reliance on just a few winners. The report stresses watching breadth indicators and volume behind the moves. If those leaders falter and there isn't broad participation from other sectors to pick up the slack, well, that's when you can get a sharp drop. And the fact that financials and defensives are already weak means there's less of a safety net underneath.
Right, no safety net. Okay, so that's theme 1, narrow, risky leadership. What's theme 2?
Theme 2 is the flip side, identifiable laggards. Financials and defensives are confirmed to be dragging hard. Knowing exactly where that sustained underperformance is happening is crucial because it pinpoints the market's vulnerabilities.
Okay, and here's where, for me at least, it gets really interesting, especially if you value a systematic approach. The sources actually spend time talking about how their own analytical model validated this whole divergence picture. They specifically said this validated a disciplined approach, the whole discipline over guessing idea.
Exactly. And the metric they used to show the system worked was the widening EV percent spread. So we defined EV percent earlier, equity velocity percentage, right? How much momentum a stock provides. The EV percent spread then is simply the gap between the EV percent of the strongest stocks, like HPE, and the weakest stocks, the biggest drags, like WU and HSY.
So as that spread got wider.
As it widened, it was the model confirming in real time that this market split, this bifurcation, was getting more severe. The key insight for you isn't just looking back at the data. It's seeing proof that a systematic, measured approach could actually identify and quantify this powerful rotation as it happened. That offers a real edge.
A definite edge. Okay, so wrapping this up, what does this all mean for you looking ahead?
Well, it means the week ending September 19th was clearly defined by that divergence. You had strong rotation, narrow leadership from tech and consumer discretionary, and a very clear, measurable drag from financials and defensives.
And the final thought, the forward-looking question left hanging by the source material, really frames the tension, doesn't it?
It does. It poses the key question for the next week. Will tech keep running with the ball, extend its lead, and keep pulling the indices up? Or will the weight of those laggards, particularly financials, finally become too much and, as they put it, drag the tape lower, triggering a broader correction?
So what does this all mean? It means you need to watch closely. Does the market broaden out? Do other sectors finally join the party? Or does it stay reliant on those few, potentially fragile leaders we talked about? That's the core tension. And that's your deep dive into the loop market discussion.